Gold, right now, is one of the hottest commodities on the planet. I mean, prices are soaring to record highs. So today, we're going to take a look at one company, MoneyMax Financial Services, that's really riding this massive gold wave. We're going to break down if this makes them a golden opportunity or maybe a pretty risky bet.
Okay, let's just dive right in. This chart? Wow. It basically tells you everything you need to know. Since 2022, the price of gold has just exploded. We're talking over 200%. That is a tidal wave of value, and it completely changes the game for any company that deals in gold. This isn't just some line on a graph. It's the engine driving literally everything we're about to discuss.
Exactly. And that brings us to the big question for anyone looking to invest, right? With gold prices this high, is a company like MoneyMax a golden opportunity for some serious growth, or is it a risky bet that's tied a little too closely to a really volatile market? Let's get into it.
All right, to answer that, let's start with the bull case. All the reasons to be optimistic. And honestly, when you look at the raw numbers, they are pretty staggering.
Okay, first, just look at their revenue. In a single year, the company's revenue shot up by nearly 39%. That's not a small bump. That is a massive leap. And it's driven by more people buying and selling gold and luxury items, all trying to take advantage of those sky-high prices.
And hey, if you think that number is impressive, get a load of the profit. The actual profit going to the company's owners grew by an incredible 87.6%. Now this is key. It shows the company isn't just making more sales, it's getting way better at keeping that money as pure profit.
So where's all this cash coming from? Well, you can see that retail and trading of gold is the main event. No surprise there, making up 78%. But MoneyMax is not a one-trick pony. They've got a solid pawnbroking business and even some secured lending. That diversification gives them more stable, predictable income, which really helps buffer them against the wild swings of the gold market.
So, if you pull it all together, you see these four core strengths. 1, they're a market leader with over 100 physical stores. 2, they're not stuck in the past. They've got online platforms. 3, they're pretty smart and innovative, offering things like lighter-weight gold items so people can still afford to buy in. And finally, they have different ways of getting funding, which gives them some really crucial financial flexibility.
Okay, that is a really strong case. I'll give you that. But, every story has two sides. So now let's flip it and look at the bear case. The reasons an investor might want to be a little more cautious.
So here's the catch. The company's greatest strength is also its biggest vulnerability. High gold prices are fantastic, right? They boost loan values, they get people to sell their old jewelry. But gold is famously volatile. A sharp drop in price could suddenly devalue all the inventory they're holding and really squeeze their profits. It's a classic double-edged sword. And here's another potential red flag. Look at this market concentration. A huge 85% of their revenue comes from just one market, Singapore. Now that means their fortunes are heavily tied to that one place. If Singapore's economy slows down, or if new rules come into play, it could hit the entire company pretty hard.
So to kind of wrap up the bear case, it really boils down to three things. First, that heavy reliance on the Singapore market. Second, the competition is intense. We're talking big players like ValueMax and MaxiCash. And third, you've got the simple day-to-day operational risks. I mean, when your business is literally full of gold and diamonds, theft and fraud are always going to be a threat.
Okay, so we have a pretty clear picture of the pros and cons right now. But what about what's coming next? Let's try to weigh the potential for growth against some of those external threats on the horizon.
Looking forward, there are two really interesting opportunities for growth. The first one is simple: expand. If they move into other Southeast Asian markets, that would directly solve that market concentration problem we just talked about. The second one is innovation. They've already launched a drive-through pawn shop in Malaysia. Can you imagine that? Getting a loan on your jewelry without even leaving your car? Bringing that kind of convenience to their home turf in Singapore could be a total game changer.
But it is not all clear skies ahead. There are definitely some threats on the horizon, and a lot of them are coming from regulators. In Singapore, there's already a cap on the interest rates they can charge. If regulators decide to lower that cap even more, it would directly squeeze their profits. And over in Malaysia, a new credit system is coming that could mean higher costs and more paperwork for the company.
And the threats aren't just about gold or regulations. Take a look at this quote. It points to a huge challenge in another part of their business, diamonds. The rise of cheaper, lab-grown diamonds is putting some serious pressure on the prices and demand for natural diamonds. And this isn't just a fad, it's a structural shift in what people want, and it could slowly eat away at the value of their diamond inventory over time. Okay, so we've seen the explosive growth, we've talked about the potential risks, and we've looked at the future. Let's bring it all together with the final piece of the puzzle, the company's valuation. Is it cheap or is it expensive compared to its rivals?
This is where it gets really interesting. If you use one common metric, the price-to-earnings ratio, which just compares the stock price to its profits, MoneyMax actually looks about 20% cheaper than its peers. But if you use another metric, the price-to-book ratio, which compares the price to the value of its assets, it looks 37% more expensive. So what does that tell us? It suggests investors are willing to pay a premium for MoneyMax's assets, and that's probably because the company's just so much better at turning those assets into cold, hard profit.
Which, brings us all the way back to our central question. When you weigh that explosive growth and superior profitability against the risks of gold volatility and market concentration, what do you see? Is MoneyMax an undervalued growth story that's ready to keep climbing? Or is it a value trap, dangerously dependent on a commodity price that could turn at any moment?
This content is intended to serve strictly and only as an informational, independent, objective summary of recent events and should in no way be interpreted, construed, or relied upon by any party as inside information or financial advice.